Welcome to our deep dive into the world of securities. Today, we'll explore everything you need to know about stocks, bonds, and other financial instruments. Buckle up, because we're about to make finance not only understandable but also exciting. First, let's start with a basic question. What are securities? At its core, a security is a financial instrument that represents some type of financial value. The most common types are equity securities, like stocks, and debt securities, like bonds. A stock represents a share in the ownership of a company and constitutes a claim on part of the company's assets and earnings. Stocks are also known as shares, or equities. When you own stock in a company, you are essentially a part owner of that company. Let's take an example to understand this better. Suppose you buy 100 shares of a company's stock at $10 per share. The company's value grows, and now each share is worth $15. You've made a profit of $5 per share, or $500 in total. This is known as a capital gain. But remember, the company's value could also decrease, causing a capital loss. Bonds, on the other hand, are debt securities. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of principal at maturity. Let's say you buy a bond for $1,000 with a 5% annual interest rate. Each year, you will receive $50 in interest. A question we often get is, what's the difference between stocks and bonds? Essentially, stocks give you ownership in the company, while bonds are a loan to the company. Stocks typically offer higher returns but come with higher risk, while bonds offer lower returns and are less risky. Let's visualize this with some historical data. Here's a graph showing the average annual returns of stocks versus bonds over the last 50 years. Now let's talk about another type of security: mutual funds. A mutual fund is a pool of money managed by a professional fund manager. It allows investors to buy a diversified portfolio of stocks, bonds, or other securities. For example, let's say you invest $1,000 in a mutual fund. The fund manager uses this money, along with the money from other investors, to buy a diversified portfolio of stocks and bonds. This diversification reduces your risk compared to investing in individual securities. Here's a question: why would someone choose a mutual fund over individual stocks or bonds? One main reason is diversification. Mutual funds are less risky because they spread the investment over a variety of securities. Additionally, they save you the effort of managing individual investments, leaving it to a professional fund manager. Let's visualize this benefit. Suppose you invest in a single stock, and its value decreases by 50%. Your investment suffers significantly. However, if you invest in a mutual fund with a diversified portfolio, a drop in one stock may be offset by gains in another. Let's talk about ETFs, or exchange-traded funds. Like mutual funds, ETFs are a basket of securities, but they trade on an exchange like a stock. This means they can be bought and sold throughout the trading day at market price. For instance, you might buy shares of an ETF that tracks the S&P 500, meaning you're effectively investing in all the companies in that index. If the value of the S&P 500 increases, so does the value of your ETF shares, and vice versa. What makes ETFs attractive? They offer diversification like mutual funds, but with the flexibility of trading like a stock. Additionally, they often have lower expense ratios compared to mutual funds. Let's visualize the expense ratio difference. The average expense ratio for mutual funds might be around 1%. For ETFs, it could be around 0.25%. Here's a bar chart comparing the two. Lastly, let's touch upon derivatives. A derivative is a financial security whose value depends on or is derived from an underlying asset or group of assets. Common derivatives include options, futures, and swaps. For example, an option gives you the right, but not the obligation, to buy or sell a stock at a predetermined price before a certain date. Suppose you buy a call option for a stock at $50 per share. If the stock price rises to $60, you can exercise your option to buy at $50 Creating an immediate profit. Why might someone use derivatives? They can be used for hedging risks or for speculative purposes. For example, an airline company might use futures contracts to lock in fuel prices and protect against price volatility. That's a lot to digest. So let's summarize. Securities are financial instruments that hold monetary value. They come in various forms such as stocks, bonds, mutual funds, ETFs, and derivatives, each with their own unique characteristics and benefits. Thank you for watching our detailed overview of securities. We hope you now have a clearer understanding of these financial instruments and their roles in investment strategy. Don't forget to like, share, and subscribe for more finance tutorials. Until next time, happy investing!